Good day everyone, I am May Ellen Gajano, one of the reporter of the Group 4, the capital budgeting under the condition of uncertainty. So for the remaining topics, I will discuss the trifecta of financial health, the liquidity, profitability, and present value. So these are the three interrelated financial metrics that are essential for assessing companies' overall health and performance.
First is the liquidity. So this is the ability of a company to meet its short-term financial obligation as they come due. A company with strong liquidity can weather economic downturns, seize opportunities, and avoid financial distress. It has a key indicators: the current ratio, quick ratio, cash to current liabilities ratio. The second one is the profitability. It is the ability of a company to generate profits from its operation. Profitability is essential for growth, investment, and shareholder returns. It has a key indicators: the gross profit margin, operating profit margin, net profit margin, return on assets or the ROA, return on equity or the ROE. The third one is the present value. So it is the current value of future cash flow discounted at the specified rate. Present value helps investors and managers to make informed decisions about the long-term investments. So how these metrics are interrelated? So for the liquidity and profitability, so yung mga highly profitable company ay maaaring mahirapan na ma-meet yung mga short-term obligation nila kung yung mga assets nito ay naka-tied up or naka-center lang sa mga long-term investment. For the profitability and present value naman, so yung present value of future cash flow ay na-impluwensyahan ng kakayahang kumita ng isang company or the company's profitability. Higher profitability generally leads to the higher present value. For liquidity and present value naman, ang isang company ay may strong liquidity ay mas madaling i-invest ang mga projects nito with a positive present value. So in conclusion, a company with a both profitable and liquid as a positive present value of future cash flow is generally considered to be excellent financial health. By understanding the relationship between these metrics, investors and managers can make informed decisions about the company's investment potential and risk profile.
Let's talk about the key indicators of the liquidity. First, the current ratio. So it is a financial metric used to assess company's short-term liquidity. It measures the relationship between company's current assets and its current liabilities. Current assets are those resources that are expected to be converted into cash within 1 year, while current liabilities are obligations that are due within the same periods. For the calculation of current ratio, we have current ratio equals the total value of company's current assets divided by the total value of its current liabilities. So current assets includes cash, accounts receivables, inventory, or other assets that can be easily converted into cash within 1 year. So current liabilities naman consist of accounts payable, short-term debts, and accrued expenses. Based on our example here, first we have to sum up the value of our current assets and the value of our current liabilities. So we have $175,000 for the total current assets and $170,000 for the value of our current liabilities. So $175,000 divided by $170,000 is equals to 1.03. So our current ratio is 1.03. So it indicates that the company has enough short-term assets on hand to liquidate to cover all the short-term liabilities if necessary. Second indicators of the liquidity is the quick ratio. So it is also known as the acid test ratio. It is more conservative measures of companies' liquidity compared to current ratio. It focuses on company's ability to pay off its current liability using its most liquid assets, excluding the inventory, prepaid expenses, and other less liquid assets. By excluding these assets, the quick ratio provides a more stringent assessment of a company's immediate liquidity positions. For the calculation of the quick ratio, we have quick ratio is equals to cash plus cash equivalents plus marketable securities plus accounts receivable divided by the current liabilities. Based on our example, we have $300,000 for our quick assets divided by $440,000 for our current liabilities. So our quick ratio here is equals to 0.068. So it indicates that it doesn't have enough quick assets to meet all the short-term obligation. So if it suffer an interruption, it may find difficult to raise cash to pay its creditors. In addition, the business could have pay high interest rates if it needs to borrow money. The third indicator is the cash to current liability ratio. So it also known as the cash ratio, a liquidity metrics that measures the company's ability to pay its short-term debts with cash and cash equivalents. It allows the investors or analysts to understand if the company can generate enough cash flow from its ongoing operation to pay off its short-term liabilities. For the formula of the cash ratio is equals to cash plus cash equivalents divided by total current liabilities. So in our example here, we have the total of cash and cash equivalents of $30,000 divided by the total current liabilities of $22,000. So our cash ratio is equals to 1.36. So it indicates that the company possesses enough cash and cash equivalents to pay off 136% of its current liabilities. So the company is highly liquid and can easily fund its debts. So let's talk about the key indicators of profitability. First, the gross profit margin. So it is a financial metric analysts use to assess a company's financial health. It is the profit remaining after subtracting the cost of goods sold. Companies use gross profit margin to identify areas for cost cutting and sales improvement. A high gross profit margin indicates efficient operation, while a low margin suggests areas needing improvement. The formula is gross profit margin equals net sales minus cost of goods sold divided by net sales. So based on our example, we have here net sales equals to $100,000. The cost of goods sold is $35,000. So 100,000 minus 35,000 divided by 100,000. So 65,000 divided by 100,000 is equals to 0.65. So our gross profit margin here is 0.65. To get the ratio, we need to multiply it by 100. So the ratio is 65%. A gross profit margin of 0.65 means that a company can use 65% of its total revenue to cover all the other expenses in its company. So the next one is the operating profit margin. Is a profitability or performance ratio that reflects the percentage of profit a company produces from its operation before subtracting taxes and interest charges. Our formula is operating profit margin equals operating profit divided by net sales times 100. Based on our example, we have net sales of $2 million, cost of goods sold of $700,000, administrative expenses of $500,000, and operating earnings of $2 million. First, we need to get the operating profit, so we need to subtract the expenses to the operating earnings. So 2 million minus 1,200, so it equals to $800,000. So to compute our operating profit margin, we have $800,000 divided by $2 million is equals to 0.40. To get the ratio, we need to multiply it to 100. So 0.40 times 100 is equals to 40%. So a 40% operating profit margin is equals to $0.40 operating profit from every $1 of revenue. So the next one is the net profit margin, or simply the net margin. So it measures how much net income or profit a company generates as a percentage of its revenue. It is the ratio of net profits to revenue for the company or business segment. For the formula, we have net profit margin equals to revenue minus cost of goods sold minus operating and other expenses minus interest minus taxes divided by the revenue. times 100. Based on example here, we have 30% of net profit margin. So, yung company XYZ earns $0.30 net profit for each $1 of revenue. The next one is the ROA, or the return on assets. It shows how much profit the company is generating from its assets. So it is expressed as a percentage, and in general, the higher the number, the better. So for the formula, we have return on assets equals net income divided by total assets. For example, we have 10 million divided by 50 million is equals to 0.2. So for every dollars of assets the company invests in, it returns 20 cents in the net profit per year. So the next one is the return on equity. So it is a financial ratio that measures the profitability of a company by calculating the amount of net income returned as a percentage of shareholders' equity. The formula, we have the return on equity equals to net profit divided by the equity. So in our example here, we have the ROE of 7.53. So for the interpretation of the example, so for every dollar of shareholders equity, P&G generated 7.53 cents in profit. The last topic, we have the present value. So it is the current value of the future sum of money or stream of cash flows. It determined by discounting the future value by the estimated rate of return that the money could earn if invested. So for the formula, we have the present value equals to future value divided by 1 plus the rate of return raised to the number of periods. So for example here, nagpautang ka ng pera sa kaibigan mo and he promised to repay in 5 years with a discount rate of 5%. So present value equals to 10,000 divided by 1 plus 0.5 raised to 5 years. So yung present value is equals to 7,835.53. So this means nag-earn ka ng interest na 216.47. That concludes my presentation. Thank you for listening and for your attention. I hope the information was helpful and provide a clear understanding on the topic. Now I'd like to hand it over to the next presenters who will covering the internal rate in return. Thanks again and appreciate your time.
So what is the internal rate of return? So IRR is a metric used in capital budgeting to estimate the expected return on an investment. So the IRR is the discount rate that makes the net present value of investment equal to 0. So when we evaluating the potential investment opportunities, so the investor is typically opting for the highest expected return represented by the IRR, which meets or increase the minimum percentage necessary for the investment. So the higher the IRR, the higher the profit from the investment will return. So here's the manual calculation of the IRR metric. Involves the following step. So number 1, using the formula, one would set NPV equal to 0 and solve for the discount rate, which is the IRR. So number 2, we have note the initial investment is always negative because it represents an outflow. So third, each subsequent cash flow could be a positive or negative because it depending on the estimate of what the project delivers or requires as a capital injection in the future. So here's some example of computation. So we have a scenario here. Assume a company is reviewing 2 projects. So management must decide whether to move forward with one, both, or neither. So its cost of capital is 10%. So the cash flow patterns for each are follows by, we have a project A. So ang initial outlays niya is $5,000. So year 1, we have $1,700. Year 2, we have $1,900. So year 3, we have a $1,600. Year 4, we have a $1,500. And year 5 we have $700. So in a project B, we have initial outlay, so we have $2,000. So in a year 1 we have $400. Year 2 we have $700. And year 3 we have $500. And year 4 we have $400. And year 5 we have $300.